Do you know that invoices issued from a company without the economic substance requirements will not be deductible from your income in Europe or in any other high-tax country? And also, did you know that all movements of your foreign bank account, according to the CRS, will be reported to the inland revenue of your home country? Good afternoon and good evening. My name is Theodor Strohal. I'm senior partner in the international law firm Strohal Legal Group or Strohal Legal Consultants. Our head office is in the United Arab Emirates, and we are running offices in Singapore, in Myanmar, and finally also in Thailand. We will have a webinar today about compliance in general in the UAE and also about legal regulations and provisions in connection with compliance. My partner and managing director of our law firm in the UAE, Jakob, will speak at the first part mainly on economic substance requirements and ultimate beneficial owners in the UAE, and I will follow then with more general terms like the CSR, the BEPS, and some more European regulations.
As a short introduction to the UAE market on why all these regulations have been implemented, it's maybe interesting to point out that the UAE were blacklisted for a long time as one of the non-cooperating jurisdictions. Yeah, Emirate, they were famous for tax evasion, shielding of funds and assets here in the UAE. And also at the same time not complying with international standards. Yeah, for a long time that wasn't a problem, but then through the blacklisting there was a big danger that the financial markets of the UAE will be blocked and that cash transactions and the holding of bank accounts and so on will not be possible anymore. So there was enormous political pressure on the UAE. Then they reacted somehow, did a little bit, yeah, where also as a consequence gray listed, so we're not anymore listed with the really bad guys, and then they thought they can continue their business model as they used to for the last 20-30 years. But the EU reacted quickly, and only after a few months the UAE were again added to the blacklist. Yeah, and ever since you can really notice the shift in the entire approach to international compliance rules. There was a lot of new things coming up, especially, I mean, from a practical perspective, the approach by the banks. Every one of us probably has dealt with it. Banks were quite eager to get new customers until a few years ago, but now most of the banking is simply a pain. It's very difficult to open bank accounts. Some businesses that are already established do not get a bank account, although they have already invested the monies for the free zone authorities. Also, sometimes what we have seen with our clients, bank accounts are simply closed without any further explanation. Sometimes every single transaction is really investigated and you have to show invoices even for the smallest payments that you make. So we really hope that this will improve soon. So far, the banks have not really found a practical way through the regulations. Apparently, there's a lot of pressure from the national bank. Now, so they seem to be afraid from the national bank because there will be some internal pressure, fines threatened, and the people that you are dealing with at the banks just are afraid to do anything that could somehow endanger them. Second issue I want to mention also, because it's just from the general perspective, interesting. So now, of course, we have the VAT that is applied. That also caused an enormous shift, you know, in the entire way of business can be handled here. And also, it is said that corporate tax is inevitable, yeah, and only a matter of time until it will be implemented, at least for the mainland onshore companies. Free zone companies will likely be still excluded for a long time from corporate tax, because if it wouldn't, then the entire system of the free zones, yeah, would to a large extent not have any justification anymore. But as taxes are a regular income of the state of the UAE, yeah, there is just an highly increased interest in what the businesses here are doing actually. Yeah, so that's one of the main reasons that before the UAE were not interested, because as long as you have paid the fees for the company establishment and the licenses, that was the only way they were really directly earning money. But now with the tax, yeah, just in all the European jurisdictions and Asian countries, they have you know, a vital interest themselves as a state. Then we come to the main frameworks and rules that were implemented in the last years. The economic substance regulations, all of us probably have heard already. Theodor mentioned it. We will just cover the most important points. Then there's an ultimate beneficial owner register. So all the companies that are established and maintained in the UAE have to disclose who the shareholders are, who the ultimate beneficial owners are, and who else is responsible for the day-to-day operations. So all the managers and so on are registered in separate registered by the company itself, but also by the competent authority. Then Theodor will explain you the most important issues about the common reporting standards, the multilateral instrument by the OECD, and the European Mandatory Disclosure Act. Yeah, and these 5 legal frameworks are at the same time the program for the webinar. So moving on to the economic substance regulations. I think we can keep this short. Of course, we have also a longer presentation available with background information on our website, but for you to know only is all UAE licensed persons. So that can be natural persons that have a license to do business, but all onshore businesses, all free zone companies, all offshore companies, and also branches of foreign companies are in principle covered by the economic substance regulations. So each of these persons which carries out a relevant activity, yeah, that's a list of 8 activities, and which also generates income from this activity in a financial year, yeah, must have a so-called adequate economic presence in the UAE. The 8 relevant activities are banking, insurance, investment fund management, lease finance, and then most importantly, headquarter business, shipping and holding company especially. Yeah, so if the UAE entity is only established to hold shares in foreign companies, which is one of the main purposes for many companies here. Yeah. Also, companies that hold intellectual property, where, for example, a German company would have to pay a license fee to the UAE entity, thereby reducing the profits in Germany. Yeah, this is clearly also a sensitive, relevant activity. And distribution and service center. So all the companies that are active in any of these activities are covered by the economic substance regulations. It doesn't really matter what is in your license. So the actual activity is relevant. Sometimes a part of the income is generated by, for example, a shareholding in Europe. Yeah, but the main business is really located in the UAE, but a part of the income is dividends from a German subsidiary. Then this business would be already relevant. Yeah, so you really would have to check if any of the provided services and business measures falls under a relevant activity. And then there are two things to do. First, the competent authority must be notified if the company performs a relevant activity or if it doesn't. Yeah, the first deadline already expired on 31st January 2021. In principle, the rule is 6 months after the end of the financial year, this notification must be made to the authority. Yeah, you explain if you carry out a relevant activity and if you do so, if there is any income generated from this activity. And only in a second step, yeah, if you fulfill all the criteria, yeah, so an existing company, relevant activity, and income was generated, yeah, you must demonstrate to the authorities that you actually have economic substance. This second report must be filed within 12 months after the end of the relevant financial period. So if your financial year would be 1st of January to 31st December 2020, you would have to file this report until the end of this year. It is not really clear what it means to have an adequate or appropriate substance in the UAE. The definitions are quite vague. It only says that it will depend on the nature and the level of activities and level of income. There's no minimum standard, but there's a few questions and issues that you should ask yourself. First of all, is my business activity directed and managed in the UAE? You have a problem if it is not. So if your manager or the UBO or the shareholder who basically runs the business is not in the UAE, it is a problem. And then you would have to certify that the major business decisions were actually made here. So there should be shareholders meetings here or board meetings that are signed in Dubai. And you really have to demonstrate that you are really passing the important resolutions here in the UAE. Other factors are how many employees you have, how much the operating costs are in the UAE, if you do have physical assets here, and again, generally, if the business actually operates in the UAE. It is possible to outsource these services to third-party providers. But again, the level here is very high, because the authorities will have a closer look on if an outsourcing provider really assigns enough resources and time to run the business properly. Here I copied the flowchart from the Ministry of Finance. So it's quite simple. First question, do you have a trade license? Do you conduct a relevant activity? Whenever the answer is no, you already fall out of the application of the rules. Does the licensee earn income from the relevant activity? Then there are special rules for holding company business and high-risk IP licenses. And then only the last step is, do you really fulfill the criteria for economic substance in the UAE? And if you do manage to prove that to the authorities, then you're fine. Basically, it's not much different from the usual questions under the double taxation agreements if you have a permanent economic presence in the UAE. So if you do fulfill the criteria of the economic substance rules, you should also at the same time fulfill the criteria of the other country under the double taxation agreement. The first, here's a few deadlines. I told you a half year after the end of the financial year, the notification deadline, and 1 year later is the reporting deadline for the economic substance. So if your financial year has ended 2020, end of 2020, you have to notify until 30 June and provide the ES report until 31st of December 2021. There are relatively high sanctions imposed, penalties of 20,000 dirham if you do not submit a notification. I have not received news about our clients who eventually have failed to do so. I mean, we sent, of course, out all the information they needed, but I assume a few have simply ignored the deadline. I have not heard that the authorities have actually imposed the fines, but it will come sooner or later. Maybe they're, not as strict this time, but for sure, after the next year, the fines will be imposed. The fines get higher if you do not submit the ES report. Then it's already 50,000 plus the negative consequence that you have failed to demonstrate economic substance. If you do not provide accurate or complete information, again, it's another penalty of 50,000. And if you, at the end of the day, fail to demonstrate sufficient economic substance, the penalty is 50,000 in the first instance on 400,000, and ultimately even suspension or withdrawal of the trade and commercial license. Then, in short, the mandatory registers. There's also something that came up last year. All the UAE mainland and free zone companies must have 3 different registers. They have to be kept at the premises in the office. The first register covers the ultimate beneficial owners. The second, the direct partners or shareholders of the company. And the third, any managers and also nominee directors. These registers have to be filed with the competent authority, and it also has to be updated regularly. The authorities are in principle obliged to disclose this information if a foreign authority has a legitimate request. So, for example, if the Austrian or German tax authorities approach the UAE authorities and want to know about Mr. Theodor Strohal, which shares he holds here, then they have to disclose this information. And also private persons and companies can directly approach the authorities and ask for a copy of the reports. Here, the good thing is that it does not have to be disclosed because approval by the company is required. But that's maybe important to know before you close a business deal. You want to know exactly with whom you are dealing with, and then you can make it a precondition to sign the contract or to let the contract become valid, and that they approve that the authority discloses the registers to you. Again, failure to comply with these rules could lead to fines of up to 20,000 dirham. And now we'll hand over back to Mr. Strohal for the common reporting standards.
Thank you very much, Jakob. Okay, so common reporting standard is nothing really new, and I held already several speeches in the Austrian Business Council and also the German Emirates Club and in Singapore about this regulation. It is actually a framework written by the OECD, and this framework probably was created by very, very, very clever people. And I don't want to read out the definition, you have them on the slide. I just want to tell you what's behind it. It means that your bank, it doesn't matter where you open your account, shall report to the country of origin, to the tax authorities in your country of origin, what you are doing with your money. That's it. And these OECD regulations were adopted by now 100 plus countries. And you still have a list of countries which were not ready until now to accept these regulations and implement them into the local law. Quite interesting here, because we are working with some of these countries. If you have a look, Armenia, not really. Cambodia is one of our, let's say, home countries. And because we have an office in Myanmar and in Thailand, and I was traveling to Phnom Penh regularly, let's say once a month, and we set up some companies there. And Cambodia does not comply with the CRS. It means when you open a bank account in Cambodia, they will not report to your country of origin. What your country of origin is, I will tell you later, which is quite an interesting definition. So Cambodia has international banking. They have the ANZ, Australian New Zealand Bank, and they also have the Malaysian Maybank. And they have a handful of local banks, about 6, 7, 8 local banks. And if you open or if you form a company in Cambodia, within the next 24 hours, you have your bank account. Really. So keep in mind. So if you want to set up a legal entity in Cambodia, can be 100% foreign owned, and your bank account can or will not be reported anyway within the CRS system. Then finally, Dominican Republic, it's beautiful there in the Caribbean, but maybe for business not really interesting. Georgia, yes, if there are no political turmoils, would be an interesting country for Europeans. Then we go further down, Morocco, and then Paraguay. Paraguay, as I worked there for altogether 2.5 years, is one of the countries I really love in South America, and they have an excellent banking system. Yeah, very convenient, very easy to handle, and also very easy to open bank accounts there. And also see the Philippines. Philippines also do not comply with the CRS. So you know that Philippines is one of the very few countries they offer lifelong visas. Yeah, if you marry either a Filipina or if you apply for a retirement visa, then you can get a lifelong resident permit. And of course, also your bank account will be not reported anywhere. Puerto Rico and finally, Ukraine, very interesting. And of course, the United States of America, they are not member, or they did not comply with the CRS. They have their own FATCA, FATCA system, which is very similar. And maybe you know, if you open a bank account, it doesn't matter where in the world, you have to fill in this form, the FATCA form for the US, that you are not taxable in the United States. So let's go to the next slide. What data will be passed on to your country of origin? Of course, name and so on. This is clear. Account number and all movements on your account. And also when you receive dividends from any legal entity, like an LLC or also a public stock company, and the dividends will be credited on your bank account, this will be reported to the tax authorities. Account balance and also the details of where you get your money from, including contracts. So the bank can ask you, please provide the invoice if the money comes in. In UAE, very usual that they ask for that. So you send them the invoice and then they say, that's not enough information. In the invoice, it says, according to our agreement from this and this date, then the bank will ask you, please send us the agreement. And then this agreement is part of your folder in the bank. And this agreement will also be forwarded to your to the tax authorities of your home country or country of origin. What can you do if you are asked by your banker when you open an account, where do you come from and what is your country of origin? I had this experience together with a client not so long ago, and the client was living in the United Arab Emirates already, I think, 10 or 15 years. And he said, well, my home country is Germany. Yes, please give me the address in Germany. He said, I don't have any address there. I left my home country about 10, 15 years ago. Then please give me your old address. He said, no, I'm not willing to give you an old address, but you have sure a German phone number. No, I don't have a German phone number, but do your parents still live? Do they have a phone number? And he said, yes, but I don't want to provide the phone number of my parents. So what is the background? The bankers are forced by the national bank and the authorities to get information of your country of origin, of your home country. And it will be quite difficult when you open an account to avoid, when you're, for instance, German citizen, Austrian citizen, Thai citizen, whoever, to avoid any information about your home country. But if you're standfast and you say, I'm living already 10 years here, I broke off all bridges to my home country, I don't have a phone number there, I don't have an address there, then the bank must accept it. And then there are no reports to your home country, of course. But what are you doing if you opened the bank account when you came to the UAE or anywhere? And of course, at this time, you had a phone number at home, you had an address. Then these parts of the file cannot be deleted. Of course, you can go to your banker and say, all information you have about my home country are not up to date because I don't have any relationship anymore. But the banker is not allowed to delete it, and he will further on report. So the only way to get out of the system would be closing your old bank accounts and opening new ones, which is quite difficult in the UAE, as Jakob already told you. Yeah. What about the implementation of the CRS in the United Arab Emirates? There are several ways how you can implement this framework from OECD. There is a wide way. It means you are member of a group of countries which provide information to all other group members. And this is the way the UAE took. So if you have a bank account in UAE and you have some relationship to Germany, Austria, UK, any EU country, and so on, then it does not need any further contractual or bilateral contract between or agreement between the UAE and your home country. UAE will report. What do you need actually to make the UAE as your home country, as your country of origin, namely to be a tax resident? Very easy actually, but of course it is not as easy as the law says. You just need the visa, the stay permit, being an employee or being an investor or whatever, you can apply for a visa, not, of course, not tourist. Then you need an Emirates ID. And finally, you need a bank statement that you have a bank account in the country. And now the Ministry of Finance who issues these tax resident certificates also will check if you spend at least 6 months within 1 year in the UAE. And if you once did that, if you once have this 6 months, then they will issue tax resident certificates also for the following years without checking your immigration file, which means you know that you only to keep up your resident permit, it needs only to come into the country every 6 months. 1 day would be enough, and you keep your visa. But for the tax resident certificate, they will first check if you really live here. So you have to send them some rent contract or a long-term hotel lease or whatever. So it is quite easy to be tax resident here. Then, of course, when you open a bank account in another country, you can say, yes, my country of origin, my country of tax residency is UAE. And you can, of course, report to the United Arab Emirates because for the time being, there is no income tax. So when the local authorities, the Ministry of Finance receives the report from wherever you earn your money, it will not be any disadvantage. Little bit different about Singapore. Singapore decided not to join this group unlimited, but Singapore reserved the right to go into bilateral agreements. So Singapore only reports to the financial or to the tax authorities of countries they have already signed a bilateral agreement. And up to date, I have not found a bilateral agreement between Singapore and the UAE. So there is no reporting vice versa. Maybe UAE will report because they took the unlimited group. Quite interesting. Singapore has, because it's a common law system, they have a trust. You probably know now trusts, of course, are also offered in the DIFC and also in Abu Dhabi. These trusts have a trustee, which is different from other legal entities because the trustee actually owns the properties and the bank accounts. And that also means that in the case of a trust, not the bank is obliged to report about the beneficial owner, but the trustee. So it is maybe sometimes easier to sit down with the trustee and convince him that you are a UAE tax resident and not a European tax resident. And if you provide the right documents like your Emirates ID and your visa and your rental contract, then most probably the trustee will accept it and will not report to your so-called home country in Europe, but he will report to the UAE if there would be a bilateral agreement. So this could be of advantage to go in for a trust in Singapore. Many more advantages. So we now come to the MLI. MLI is a system actually to implement in the double taxation agreements. And MLI forced the OECD member countries and the ones who signed these multilateral agreement to go through the wording of the double taxation agreements and implement these regulations about tax avoidance, about profit shifting, and all that what is, let's say, summarized under treaty, how you call it, treaty choosing and choosing the right bilateral taxation to your business. So treaty shopping, that's the right expression. So like many companies did it, they set up the company in a low tax country and with a good double taxation agreement with their home country or with a country where they make profits, and they shifted the profits into the low tax country. So with treaty shopping, they could avoid taxes. So this shall be prohibited by signing this MLI agreement. So we go then further on, and besides the MLI, we have the EU, yes, the so-called Meldepflichtgesetz, which actually is a mandatory disclosure act and is based on a EU regulation which has been implemented by all EU countries in 2019 and set in force 2020. And this mandatory disclosing act means that you are obliged as a taxpayer in the European Union to inform the authority if you find or if you're planning even to implement a new corporate or other system into your business to avoid taxes. These regulations finally are not so new. If you look at our next page, which is the main point, what to be fulfilled, and you see that these regulations are very close to this multi-benefit test, is very close to the already existing tax laws in all European countries, which say about that every legal structure which is legally compliant, but if the structure is set up only to save taxes, or that the main purpose to set up this structure is to avoid taxes, then the tax authorities are allowed to tax you by just deleting, by just ignoring the structure you set up. And this multi-benefit test just repeats these legal regulations which are found in the Bundesabgabenordnung in Austria or in the German Abgabenordnung, which are rather identical. So there is nothing new about that. The main points: who is, whose duty is it to inform the tax authorities of such new structures? In principle, all intermediaries. So if you have somebody who is ready to set up a structure and helps you to change your company formation, and you make a subsidiary in a low tax country, and you make a branch in another country, then finally the one who advises you, your intermediary, also the one in the very country where it's low tax, let's say Czech Republic has by far lower taxes, or also Hungary has lower taxes. So if you are now diversify your structure in the high tax country and set up a new structure to save taxes, then all your advisors are these intermediaries and are obliged to report to the tax authorities. And not only after you set it up, already when you're planning to set up, the intermediary is obliged to report. And on the second level, all tax advisors and lawyers who advise you are also have the same obligation to report to the tax authority in advance and say, hello, dear tax authority, my client X is planning to set up a subsidiary in Singapore and another one in the UAE, and he is planning himself to change his residence to the United Arab Emirates to save taxes. So all this had to be disclosed in this law, according to this law, to the tax authorities before you even take the steps. Well, I don't want to comment it. I only can assure you that our firm, our law firm, has no subsidiary within the UAE, and this is a UAE is a European Union law, and we do not have any subsidiary within the European Union. Both Jakob and myself were barred in Austria, but we both retired or resigned. So we are not obliged to report any of our clients' good ideas how to save taxes, or if we provide them with good ideas, we are not within the European Union, and this law does not affect our work. So these are, let's say, the main points of this, let's say, rather peculiar law, and I rather wonder if really the tax advisors in the European Union are following this law, and the intermediaries are reporting what they advised the various companies and clients to save taxes. Well, so far my contribution tonight. I hope you found it interesting, and you will, of course, also receive our PowerPoint presentation, and we are here also to answer your question. Thank you very much.